What's up everyone, it's Scotty with MoneyBest. So in today's video, we are going to be talking about Vici Properties, ticker symbol VICI. A lot of you guys have been asking questions about this business, and for all of you guys who've been part of the channel for some time, you guys know that I do like Realty Income Corporation, ticker symbol O. And I do have that as part of my dividend portfolio, but we're going to take a look at VICI as well. A little bit of different demographics in terms of the portfolio of tenants that this company has compared to Realty Income Corp, obviously. And we're going to take a look at the cash flows. We'll talk about the fundamentals, the technicals, all those things. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. And of course, link to our Discord and Patreon is going to be down below if you're interested in joining. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, members only videos, intrinsic value spreadsheets. Everything is going to be included with the link down below. So when it comes to Vici Properties, they own 54 dynamic gaming destinations and 4 championship golf courses located across the US and Canada. They are a REIT. Again, they are a real estate investment trust. So by law, they're required to pay a significant portion of their earnings as part of the dividends. And they own, acquire, and develop single tenant, triple net lease properties, which we'll go over what triple net leases are, with a focus on best-in-class gaming, hospitality, and entertainment destinations. That means that Vici owns a real estate, but the tenant, in this case a casino operator, is responsible for all operating expenses, including rent, taxes, insurance, and maintenance. And that's really what a triple net lease is all about, where the tenant or the lessee promises to pay all the expenses of the property, including real estate taxes, building insurance, and maintenance. And these expenses are in addition to the cost of rent and utilities. And of course, there are net leases that are only single net leases or double, which basically tack on the property insurance as well. So there are single, double, and triple net leases for different REITs. And of course, Vici falls under the triple net lease, which is pretty good because, again, they don't have to worry about anything. It's all the tenants that they have to pay for everything, including utilities, taxes, insurance, maintenance, and rent. So going over to some of the investment highlights. So they are a triple net lease REIT that owns one of the largest high quality portfolios of market leading gaming, hospitality, and entertainment destinations. So we're going to take a look at the portfolio here in just a minute. But if you take a look at their scale, $2.9 billion in annualized cash rent and 100% of rent collection from formation to date. That is a pretty significant, well-run management and collections team out there that is pretty much collecting almost all, not even almost all, of the rent that they're due. And 80% of the companies that are renting from Vici are public companies. So they are 80% of rent roll derived from SEC to reporting operators, providing transparency into the tenant performance and financial health as well. And they were added to the S&P 500 in June of 2022. They are actually a fairly recent company. Like if you come over to VICI, they haven't been around for that long. So they basically were established or founded in 2016, right? So they have they're a fairly new company. And since 2017, you'll notice the stock price has obviously gone up a little bit over 126%. So of course they haven't, they haven't been tested the time, basically in terms of what's that saying? They haven't tried the test of time, or they haven't survived the test of time, I should say, right? Because Realty Income Corp, on the other hand, has been around for decades, right? It's been around since 1990s, and you'll notice that it was actually founded in 1969. And the stock price has obviously done really well since 1994, up over 4,700%. So it's going to take some time for us to really understand, okay, and under different circumstances, different cyclicality, how does the business shift? And the biggest challenge obviously came for Vici Properties during the COVID-19 pandemic, when most of the gaming operators and casinos and everything were shut down because of work from home and of course of this global pandemic that we were dealing with. But even then, they actually performed really well. This right here are the different operators and tenants that are part of the Vici's portfolio. They've got 18 Caesar restaurants, 13 MGM resorts. We've got Penn Entertainment, we got Jack Entertainment, Century Casinos, we got Cherokee Nation, we got Eastern Band of Cherokee Indians, we got Foundation, Pure Casinos. So 54 properties and 11 tenants, and over 41.8 years is the weighted average lease term, or WALT, as of June 30th, 2023. So 100% of them are triple net leases with over 90% of rent roll with parent guarantees, 81% rent roll with master lease protection, 80% from SEC corporate reporting tenants, and 76% from S&P 500 companies. So these are, very well brands, very well known and popular brands. I mean, MGM Resorts, Caesars Restaurants. I mean, these are pretty big restaurants and pretty big casino operators in the world. And we'll go over some of the stats here in just a minute, but 2.9, almost $3 billion is the annualized cash rent, which 40% is coming from Caesars Restaurants and 36% is coming from MGM Resorts. So the only sort of, I guess, the risk with Vici properties would be the concentration of rent, right? I mean, 76% is coming from two brands, right? That's your Caesars Restaurants, Caesars Entertainment, not restaurants, Caesars Entertainment and MGM Resorts, right? These two tenants make up over 76% of the rent roll for Vici properties every single year. So if something were to happen to these companies, Vici properties is going to be a bit of a trouble because that's about over $2.1 billion in annualized rent roll. Whereas if you take a look at Realty Income Corp, it's a little bit more diversified, right? You've got a lot of different companies, a lot of different tenants as part of the portfolio of Realty Income Corp, and there's no one or two or three single companies that make up over 50, 60, 70% of the rent roll for Realty Income Corp, right? It's kind of diversified between a lot of different companies, or tenants, I should say. With Vici, that's not the case. But, this could be both a positive and a negative for the company. Positive, so to speak, because these are very high quality, popular brands, part of the S&P 500, part of the reporting transparency sort of metrics. And, Vici properties can take action prior to these companies defaulting on the rent. But then at the same time, the negative because of the concentration risk that I just mentioned. Now, this is where all these properties are located. So, of course, a lot of these places are known as the hubs for gaming, entertainment, casinos, not to mention gambling as well. So, geographic diversity by rent, so 52.4% regional, 46% is coming from Las Vegas, of course, because Las Vegas is Las Vegas, and 1% is international, right? So, a lot of their properties are going to be in Las Vegas, and then we've got Detroit, we got Cincinnati, Louisville, we got North Kansas City, down south, and of course in New York and Philadelphia and Cleveland as well. So Las Vegas, one of the world's preeminent tourism cities. So in 2022, 39 million visitors with over 5 million convention visitors, $45 billion direct visitor spend, and $8.3 billion in gross gaming revenue, all-time annual record in 2022. And of course, the place also has 11 of the 20 largest hotels in the world as of 2022. Stanley Cup Championship, Las Vegas Raiders, and potential new home for the MLB Athletics, new Formula One racing site, host city for the first NBA in-season tournament Final Four, host city for 2024 NFL Super Bowl, and host city for 2028 NCAA Final Four as well. So lots of sports and athletics also moving in that city in 2024, 2028, and of course in the years to follow, which obviously leads to more traffic, which leads to more revenue, more gaming revenue for these operators, which leads to the possibility for Vici to raise rents in the future and continue to kind of increase their ability to generate more revenues and cash flows and as a result, more dividends. Now, speaking of dividends, Vici's dividends durability and growth. So 100% cash dividend raised every year while targeting a 75% payout ratio from their funds from operations. So that's what the level's been. And of course, every single year since 2018, they've been able to raise dividends by about 7.6%, which is significantly higher than compared to Realty Income Corp's 4%. So almost twice as much in dividend growth because it's a fairly new company. So you understand that, of course, they're growing right now. The rent is going up. Of course, a lot of companies that are part of the portfolio are doing really well. And as a result, they're increasing the dividends at a much higher clip than compared to Realty Income Corp. Now, their net leverage ratio. So they do have about $14 billion worth of unsecured debt and a $3 billion commercial mortgage-backed security backed by MGM Grand Las Vegas and the Mandela Bay. So overall total debt's over $17 billion. And of that, they've got a $2.5 billion revolving credit facility, of which they've used about $105 million. So $17 billion of total debt. Cash is sitting at just about $739 million. So net debt's at $16.3 billion. You'd expect nothing less from a REIT. And then, of course, they've got the total enterprise value at $47 billion. And The total leverage ratio is 5.9 according to the EBITDA. So EBITDA is going to be at 2.9 billion dollars. That's your earnings before interest, taxes, all the amortization on an adjusted basis. So 5.6. I mean, ideally, I want this number to be a little bit under 3, but it's a REIT, right? I mean, you can't complain here. 5.6 is decent. I think Realty Income Corp might be a little bit better than Vici. I have to double check on this specific metric, but the interest rates that they're financed on all these loans on these unsecured borrowings is quite reasonable. I mean, it's at 4.2, 4.5%. We've even got notes as low as 3.75% and 3.875%. And some of the longer duration at 2052 and 2032, they're sitting at over 5.6%. 2024, this one's coming in due at 5.6. And of course, since rates are a lot higher now, it's possible that these interest rates move up on an average basis, on a weighted average basis, because a lot of these are going to get replaced by new debt, which of course is if Vici Properties takes on new debt to replace old debt, they're going to be doing it at much higher interest rates than what they were locked in at previously. So right now it does say 99% of fixed rate debt outstanding, but that fixed rate is possible that it starts to go up, considering that they are going to replace some of this debt that's coming due in 2024 and 2025. Now, when it comes to total revenues, like I said, it's a fairly new company. So 2014, 19 million. They've been able to grow that to over 3.3 billion on a trailing 12-month basis. Operating income also very, very strong at just under $3 billion. And we've got EPS, funds from operations, EBITDA, everything moving and growing in the right direction. Again, we don't have a lot of data when it comes to the fundamental analysis aspect because it's only been around for a few years compared to, of course, when we're talking about some of the other REITs. But nonetheless, it's moving in the right direction and, of course, doing everything right to grow their earnings and their funds from operations. Now, when it comes to EPS or funds from operations, I should say, for REITs, 246 expected to basically be at around 250s and 260s and 270s because there's not a lot of growth expected for the company. So 89% growth this year, but then a modest 5.5%, 4.2%, and then a decline in 2026 for funds from operations for this business. Now, valuation is quite reasonable. And when we do account for price over funds from operations, it's trading at around 12 to 14 times, which actually is not that bad compared to the sector median, which is like quite comparable to where it's trading right now. And of course, we do have a price of sales at a little bit over 9, which does seem a bit too expensive. And then, of course, the dividend yield is going to be sitting at just a little bit over 5% for the company, right? So dividend yield on a forward basis is 5.32%, which actually is quite comparable to that of Realty Income Corp at 5.3%. So in my opinion, I think this is a stock that can add more flavor to your dividend portfolio and a little bit more diversity because, like, for example, I own Realty Income Corp that is specifically focused on the retail sector, right? There's no office buildings in that particular REIT, and there's 7-Eleven, there's Walgreens, there's Target, CVS, health and fitness companies, a lot of conventional stores, general stores, pharmacies that are not really gonna be not used, right? These are not companies that people are going to one day all of a sudden stop going to, right? I think even Costco is part of Realty Income Corp's tenant portfolio. So people need to go there, right? People buy groceries, people buy, medicine, pharmaceutical products, all those different things. People need to continue to go there. But with gaming and casino operators, it's a little bit different, right? I mean, it's more of a discretionary thing, right? People don't need to go there, but yes, people always go there because that's gambling at the end of the day is an addiction, right? Going to casinos and of course playing slot machines and all those things at the end of the day is something that people are addicted to, as unfortunate as it is. So, and that is not going away anytime soon either. Like, that's more of a behavioral pattern that people are accustomed to and are at the mercy of their emotions. They're going back there every single year, every single quarter, whatever it is, whatever their frequency is. And as a result, Caesars, MGM, like all these resorts, the house always wins, and they're going to continue to win, in my opinion. So it certainly, in my opinion, can add a little bit of diversity to a portfolio, 5.3%. But the only risk that I wanted to mention is, of course, the net leverage ratio, a little bit high at 5.6. And not to mention the concentration of the rent roll, which is very much focused on Caesars and MGM, which makes up over 76% of the overall rent. But nonetheless, it looks like they actually did really well during 2020. So the revenue and the earnings didn't decline during that time. In fact, if anything, they again increased in 2020 as well to 1.2 billion, and net income also did increase to over almost $900 million. So they've been able to consistently grow, although margins have been coming down for the profit, so 43, 42%. Profitability has been a little bit more stagnant. And of course, the payout ratio is going to be a little bit over 71, 75% for the company as well. So I like Vici Properties. And just like Realty Income Corp, it's going to offer some opportunities, maybe sub $30 could be a level to start looking into this stock a little bit more. But as long as you're comfortable with the things that I mentioned with the gaming sector, casino sector, being a little bit more different than, of course, retail and conventional stores, the net leverage ratio, and then, of course, the concentration of rent roll. If you're comfortable with those things, then I do like Vici at these prices, 5.3%, and adding a little bit more diversity to a dividend portfolio or a REIT portfolio, which may already have, let's say, MAA, which we've talked about before, Mid-America Apartment Communities. So that's more residential apartments. And then, of course, Realty Income Corp, which is more retail. And then even DLR, which is your digital realty trust, that's going to be mostly on cloud servers and data centers. And then, of course, Vici, which can add a little bit more towards that gaming and casino side of things. So support level is going to be at $29.50 from a technical perspective, all the way down to as low as $24. Of course, the lower the price gets, the higher the yield becomes. That's how inversely they're traded. But this right here, $29.50, would be a decent support level to watch, with the resistance all the way up to as much as $33, $34 per share. So let me know your thoughts down in the comment section below. Bottom line, I like it, but there are a few things to consider before you start adding this stock to your portfolio. But let me know in the comment section below, what do you think about Vici Properties? And as always, make sure that you drop a like, subscribe to the channel. Link to our Discord, Patreon is going to be down below. Happy investing. I'll see you all in the next video.